Okay, so this month the crypto crowd got some brutal news, and half the internet immediately declared the whole institutional dream dead. The Bitcoin funds that Wall Street launched, the ones that were supposed to bring the big money in, just had their worst month ever. Investors yanked a record amount of cash out, and the takes wrote themselves. See, the suits never really wanted crypto. It was a fad. The institutional moment failed. But here's the thing: nobody, rage quitting the ETFs, actually checked. While everyone was walking out one door, one firm quietly got a whole lot bigger. $4.5 billion walked out the door in a single month, a record. So the story is crypto lost. But money doesn't vanish, it goes somewhere. So who won? Let me show you. First, the exodus was real. I'm not softening it. United States Bitcoin funds bled a record $4.5 billion in June, capping a brutal streak of more than 10 straight days of withdrawals. Year to date, more than $5 billion has left. Retail looked at that and saw capitulation. The big institutions are bailing, the experiment is over, the party's done. That's the vibe everywhere right now. So you'd expect the biggest player, BlackRock, the largest money manager on the planet, to be shrinking right along with it. Right. Except, and this is the whole video. While money poured out of the sector, BlackRock's Bitcoin fund got more dominant, not less. It now holds around 765,000 Bitcoin, and it accounts for the vast majority of all the trading happening in the entire category. The sector shrank, and BlackRock's slice of it grew. The money wasn't leaving crypto. It was leaving everyone else, and consolidating into the one name that already runs Wall Street. Here are the actual numbers. BlackRock's fund now holds about 61% of all the assets in the Bitcoin fund sector, and roughly 74% of the daily trading volume. Almost 3 out of every $4 changing hands run through BlackRock. That is not a firm retreating from crypto. That is a firm cornering it, and it isn't stopping at Bitcoin. They've launched a staked Ethereum fund, a Bitcoin income fund, and a tokenized treasury fund worth about $2.5 billion. So where did the money that left the cheap fund actually go? Here's the mechanism, and once you see it, you can't unsee it. A plain Bitcoin fund is cheap and boring, it just holds the coin. But BlackRock built a whole menu on top of it. Funds that pay you a yield, funds that generate income, funds that hold tokenized government bonds. Every one of those charges a fatter fee than the plain fund. So when a big investor sells the cheap Bitcoin fund and rotates into the yield product next door, it shows up in the data as an outflow. It looks like they left. They didn't leave. They traded up into a product that pays BlackRock more. The record outflow and the higher fee upgrade are the same money. Cheap fund out, higher fee stack in. Same money. The outflow that everyone read as crypto dying is, in large part, Wall Street's own clients upgrading into the more expensive products Wall Street just built for them. It's not an exit, it's a renovation. It goes way past the funds. This is the part that actually matters. The biggest clearinghouse in finance, the one that settles more than $100 trillion in trades, is running a pilot with over 50 firms to move real assets onto crypto rails. JP Morgan, a bank whose boss spent years trashing Bitcoin, has quietly tokenized around $800 million on Ethereum. PayPal's dollar stablecoin just went live on a crypto network. Every one of these is Wall Street rebuilding the plumbing of finance on the exact technology it publicly mocked. They didn't lose interest. They're building the toll booth so that when everyone drives onto these rails, they own the road. Now the honest part, because I'm not here to sell you anything. This being great for BlackRock does not mean it's great for you or for the price of Bitcoin. The coin can absolutely keep falling while the rails get built. One of the big banks even cut its Bitcoin target on weak fund demand. And Wall Street owning the plumbing is a double edge. More adoption, sure, but also more control, more fees, and more of crypto's whole point, cutting out the middleman. Quietly handed back to the middleman. This is a story about who profits, and the answer might not be the little guy holding the coin. Here's the read I'd leave you with. When a whole crowd is celebrating that the institutions left crypto, check whether they actually left or just changed which door they're standing at. This time, they didn't leave. They consolidated, they upgraded, and they started rebuilding the rails for themselves. So don't watch the price this week. Watch who owns the plumbing, because the money that looked like it walked out is the same money quietly buying the toll booth. That's the asymmetry. I'm Frankie, one Contra Ryan read a day. Subscribe.